Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe this channel. Stock slumped to two-year low as rates reality beat. Stock hit a two-year low on Friday and bounced eight big weekly losses as the prospect of U.S. interest rates rising further and faster than expected rattled investors, while a rising dollar had currency markets skittish following Japan's intervention. Interest rates rose sharply this week in the United States, Britain, Sweden, Switzerland, and Norway, among other places, but it was Federal Reserve members' outlook for persistently high U.S. rate through 2023 that set up the latest round of selling. MSCI's World Stocks Index touched its lowest since mid-2020 on Friday and is down about 12% in the month or so now. So since Fed Chair Jerome Powell made clear that bringing down inflation would hurt, S&P 500 futures struggled to steady in the Asia session and fell 0.1% while European futures were flat. MSCI's index of Asia shares outside Japan fell 1% unless it bounces. It is on course for the worst month since March 2020. It's reality coming true, said Sean Taylor, Asia Pacific Chief Investment Officer at DWS in Hong Kong. We had a market that believed rates were coming down next year. Now that's changed a lot, he said, and the equity market is now adjusting to that. Bond and currency markets are also unmoored with the last lift in US rates extending a rally in the dollar that is starting to cause some discomforts for trading partners. The euro and yen fell to 20-year lows on Tuesday until Japanese authorities stopped into the market to the first time since 1998 to buy yen and arrest its long slide. The resultant spike has the yen up to 142.20 per dollar and on course for its best week in more than a month. Two analysts say the yen's respite is likely to be short-lived. Other currencies were struggling for traction. The euro was at 0.1998 and $25, barely above its low of 0.98 and $7. The Australian and New Zealand dollars hovered near their lowest level since mid-2020. Sterling was sparked by its lowest in nearly 4 decades and at 7.10 and 28 per dollar. China's yuan is within striking distance of a record low. Bond markets have been in meltdown as both investors and policymakers grapple with how far short-term rates will need to rise to tame runaway inflation around the world. Britain is a case in point. On Thursday, a divided Bank of England hiked rates 50 basis points (BPS), disappointing currency traders, while promising bond sales and further hikes that, together with fiscal policy, tank yields along the curve. Two-year gilt yields are up nearly 50 bps this week, on track for their worst week in 13 years. Later on Friday, new Finance Minister Kawasi Kwarteng will announce a fiscal plan that is probably inflationary and even more bad news for gilts. Treasuries didn't trade in Asia owing to a public holiday in Japan, but longer debt issues were dumped overnight, sending the 10-year yield up about 20 bps to 3.71%. The 10-year was playing catch-up to the newly celebrated cash rate, said Wedbush's head of rate strategy, Damien N.C. College, inside Sydney. If you believe the front end is going to peak at 4.60%, can you really sustain 10-year bond yields at 3.70%, he said. It's very skittish price action. I think that this volatility continues in all markets in the near term until the rates market settles. In commodity markets, oil was on track for a small weekly loss as rate hikes rise demand concerns. Brent crude futures hovered at 19 and $7 a barrel in Asia on Friday. Okay, that's all from me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.